Hi, this is Bo Yoder. Welcome to the free Forex lesson from forextradinglessons.com. If we start off on a 480-minute chart or an 8-hour bar chart, which is probably my favorite time frame for looking at the overall trends of the foreign market exchanges. In this case, we're looking at the US dollar versus the Japanese yen. Moving into the first of the year, we were experiencing extraordinary trends in these foreign currency exchange complexes. Great trends, then equally predictable and therefore profitable ranges, real clean range-based environment through the beginning of January and into February. And then we had a fairly sustained downtrend into March, which again offered very easy profitability to both the long and the short side. There were some good tradable reactions on the long side in smaller time frames, setting up rallies to resistance for trend trades to the downside. Since then, though, over the last couple of weeks, we've experienced a near-perfect anti-trader, anti-trend type environment, one that has provoked a lot of frustration for the clients I have in my video newsletter from 5minuteinvestor.com, and also the clients who've bought the Easy Forex course. So I wanted to talk a little bit about the changing environment, how you can adjust your trading style to capitalize on this whipsaw environment, and whether it's better to just back away and not trade or adjust trading strategies, as I mentioned before, in order to capture what profits the market makes available during this choppy time. If we drop down to a 60-minute chart, of course this is still the US dollar versus Japanese yen, you can see that the classic trend trading styles wouldn't have produced much of anything during this time. We had established uptrends that formed lower highs and lower lows, that then immediately zoomed up to make a higher high and a higher low, and then a lower high, and so forth. We see this engulfing action happening again and again, where the market establishes a low, establishes a high, the highs are broken, the lows are broken, and the market moves back into its range. Just most recently today, we have seen exactly this action once again. We saw the highs taken out during this movement here, surrounding the 10 o'clock numbers. Then we saw a big sell-off, broke down to a new low, took out that low, and now it looks like it's reversing back up towards the middle part of the range. So this begs the question, obviously in this kind of an environment, any trend trading style is going to be very frustrating and not profitable. So how do we adjust our trading style to deal with a chaotic type market? Well, obviously there are two modes of behavior. One is to identify quickly that the trend trading styles are in a payback environment and they're not going to be as profitable or profitable at all, and therefore stop trading those programs. For many who've participated in the rallies recently and the clear volatility that we had during the base in, I guess it was February, there's a lot of open profits on the table. So taking a few weeks off might not be a bad choice at this point. Take a vacation, get through the chop period, come back refreshed and ready to trade in the trend that is likely to follow. Because make no bones about it, markets tend to cycle from trend to chaos and back to trend. So after a while of dealing with this chaotic environment, the trend will reemerge, and we should have some great trend trading profits as a result. But for those of you who are looking for income in the meantime and don't have the luxury to take off, then it's time to look at some of the range trading styles that this market has made available. As you can see here, the range that the yen has established is very easily defined and quite predictable. We've had a number of tests here which have produced very clear profits to the downside when the highs are tested and to the upside when the lows are tested. Currently we're in a buy stage, having tested the lows of the range, and it looks like we're likely to move up towards the middle of the range. For these kind of range trades, I like to fade into the instrument as it breaks out or tests the edge of the range with a fairly healthy arbitrary stop on either side. And then having built that position, sell into the snapback as it reaches or breaks through the middle of the range. So for any of these sells or buys, your profit target is going to be more or less the 118 even area, as that is the center. So somewhere between 18 and 1810. The good news is that these range-based trades have all been quite profitable and quite predictable. The bad news is that the risk-reward ratio on these is usually only 1-to-1 or slightly better. So you've given up all of the power of risk-reward that a trend trading style delivers, and instead you have established a high accuracy, low risk-reward trading model, which is more of a grinding type profit based scenario. You're going to have a winner, a loser, a winner, a winner, a loser, a winner, a loser, and the distribution is going to be much more chaotic At the end of the trading period, you might have 20 trades. You might have a 65% win rate, so you'll be up a few units. But it's not the kind of home run profits that you can generate from the trades we've seen previously, where you could jump in with a 20 pip stop and pull 100 to 150 profits in either to the upside or downside. So treat these trades with a little more caution. Be willing to fade into the ranges and fade the breakouts and the breakdowns, as that seems to be certainly the area of predictability in our current market environment. But don't bet the ranch on these trades. These trades are often the downfall for people, as they have such a high accuracy rate. People will put together 5, 6, 7 winning trades in a row and increase their leverage, increase their risk each time. And then when the eventual breakout occurs and the real trend begins, not only do they miss the trend and the profitability from that sustained move, but they take their stop loss in a radically increasing volatile environment on their largest position size, because they've been gradually increasing. So don't fall into that trap. Know that this is a high accuracy, low risk reward type scenario. Stick to a fixed position size, as I advocate with pretty much all of my positions, and just grind out a few profits while you wait for better times to appear. Again, if we go back to the 480-minute chart for a moment, we can see that this range which is forming is either a low-level base, which will produce some nice profits to the upside as the market reaches up to retest this area of resistance around 121,500, or this is a bear flag and a lower high, at which point the market will break down, probably retest the lows around 115.25 or so, and then break down even lower. So as I said before, in the smaller time frames, the fading style is going to be profitable for another probably week or so. Then we'll see our breakout, and once that occurs, we should start to look for trend trades again, flags, pullbacks to areas of support, or rallies to resistance if the market breaks to the downside. So as always, in any market, being agile is enormously important to maintaining profitability. Knowing where you are in terms of payout and payback cycles and applying that analysis is also extremely important, and it's something that has helped to keep my nose clean during this last little period of chaos. Hopefully these concepts will help you in your trading, help you avoid some of the common pitfalls. For more information or for private consultation, please visit my main webpage at 5minuteinvestor.com. Also, if you're interested in the video newsletter in the Forex markets and seeing how I've been adjusting myself over the last couple of weeks, there is a free trial available at 5minuteinvestor.com as well. As always, thanks for listening. My name's Bo Yoder. Good luck and good trading.